Good morning and welcome. Of course, after everything that's happening around the RBI as well as the governor's comments yesterday, we're going to try and break down what's happening on the banking front. I'm Harsh Saita. You're watching BQ Prime. Thanks for tuning in. What we're going to try to do is try and break this down a little further. We have with us a market veteran and expert, Deepak Shenoy of Capital Mind, who's going to help us break this down better, help us read between the lines with regard to what the governor had to say on various pieces, including NBFCs, MFIs, as well as unsecured lending, including from all lenders, from banks all the way to NBFCs. Welcome and good morning, sir. Thank you for joining us.
Thanks so much, Harsh. It's a pleasure to be here and an honor as well.
Right, sir. So, sir, let me first off start with regard to growth. So clearly, what has been flagged off by the governor is he's spoken about uh, the suggestion, or he suggested that growth should actually be more tempered in some of these spaces, especially with regard to banks lending to NBFCs, unsecured lending. Those two are the topics where he spoke of with regard to growth. What do you make of this commentary, and what do you believe are the most impacted players in this particular space, unsecured as well as NBFC, from a growth standpoint?
Okay, so I think NBFCs, the rule that's come in from a circular perspective is that bank lending to NBFCs, whether the NBFC sector is secured or unsecured, does not matter. The point is that bank lending to NBFCs will get a higher risk weight, regardless of whether the downstream lending is secured or unsecured. That means if you saw a bank lending to, say, a Shriram Finance, which is largely an auto lender, used and two-wheelers, these loans to that NBFC will have a higher risk weight, and that risk weight has, for at least Shriram Finance, nearly doubled, I think, but in some places it's gone up quite a bit. The point over here is the cost of funds effectively should then get higher for an NBFC, because now banks have to place higher amount of their capital as I think because of the higher risk weights, and then therefore the cost of funds for banks will rise, and they will effectively raise interest rates for the NBFCs that borrow. On the other hand, the NBFCs have the other side of the problem, which is when they lend to unsecured personal loans, whether it's credit cards like SBI cards, whether it is regular personal loans like most of them, or loans against consumer durables, which is what is very popular nowadays, they will have to put a higher risk weight on their loans. This part, I don't think the NBFCs are so bothered about, at least in the listed space, because a lot of them have very high capital adequacy ratios. And it's only those that have relatively low capital adequacy ratios that you have a problem in. And those, I don't think there are too many of them. There's probably some layer of growth that is already kind of being tempered down by RBI's thought processes. But in general, NBFCs will not stop growing simply because the RBI, this is a very normal statement for RBI to make. They will issue a warning saying, look, something is overheated. And then, they'll look at how banks and NBFCs react. Once if they don't, mostly banks and NBFCs don't react too much. They continue doing their own thing. And then RBI will come down with a harsher rule or a circular that says you can't do this or you can't do that. And then, things get more serious. And then growth does come down. So growth will come down for a lot of these NBFCs. I just don't think listed space is impacted so much.
Understood. Sorry, I'm going to coax you further on this one. So, you've given us a beautiful overview on what's happening. But within that, what you've suggested is the cost of borrowing is going to go up for NBFCs, and cost of capital for banks is also going to go up. Do you expect them to pass on some of these higher rates to customers? And do you think that may actually impact customer borrowing as well?
So some part of it you don't even see, right? Like, for instance, if you go and take a loan against a consumer durable for 3 months, zero cost EMI, nobody's telling you that the lender is earning roughly 25 to 30% on that loan, while you're paying what you think is 0% EMI. So In that case, because the range of returns is so high for the NBFC, they might be willing to either take a hit and go down to 28, 27, 26%, or they might demand a higher cut from the manufacturer, because typically it's a subsidy passed on by the manufacturer to the financier, which is usually 4 to 5%. They might ask for, okay, instead of 4 to 5%, give me 7 to 8%. And that might be one way to keep the consumer from continuing to pay 0%, effective 0% EMI. But that part I think is not going to get affected. This personal loans itself, and there the loan rates, there is some sensitivity to loan rates. But I believe that all these NBFCs charge anywhere between 12% to 25% on personal loans. So there is some possibility that a certain set of NBFCs will have to increase rates. But I mean, it will take some time. It will have to flow into the system. There will be some places where rates go higher, and some places where NBFCs will have to take a hit on their own margins and effectively their NIMs.
Right. So how much time in your view will it take for it to translate?
Oh, it takes a long time. It's typically you get a rule like this, and then it takes 6 months, 3 to 6 months for borrowing costs to adjust appropriately, right? So NBFCs don't have loans all the time. They don't keep on bringing their loans all the time. They do have short-term borrowing from banks.
Sure.
So what they do is they take 1 year borrowing from banks. So until those resets come, their rates are more or less fixed, right? So it's when the resets come is when their loans reprice, and that's when it passes on. So when RBI increased rates last year, deposit rates didn't go up for the longest time.
Correct.
Lending rates stayed. That means fresh loans lending rates stayed, because deposit rates were typically resetting after 6 to 7 months.
Right.
So you're going to see this impact happen downstream. Meanwhile, RBI is going to get even more and more pensive about the fact that growth is not coming down. They might do new rules before effective cost of borrowing actually goes up for NBFCs. So it will take, it's a bit of a, RBI wants things to slow down, at least start to slow down now. But I don't think that it's got so much momentum, growing at 22 to 30%. You're going to continue to grow at 22 to 30% because the growth is available in there, and credit demand is very big. Increasing loan rates may not necessarily deter consumers from taking it. Eventually, the NBFCs will keep trying to borrow even at higher rates, pass on the higher rates to consumers, where there is potential evergreening at the customer end itself, because the customer simply might be, I'll borrow from a different NBFC and pay off the first one. I don't care about the interest rate. That kind of thing requires better credit underwriting, but sometimes things slip through the chinks. So you'll have some layer of higher rates. Those things take some time for that to kind of get arrested. Meanwhile, I expect that RBI will say, you guys are not paying attention, this is really serious, I will do more laws, and then there will be a bigger circular that comes that says it may actually cut off lending. Banks lend a lot to their own NBFCs, that means NBFCs of their own group or NBFCs that they own. They're not going to stop credit to those NBFCs because they own them, right? So it's just going to change the structure of interest rates a little bit. So you're going to see this take a long time to go down. It's not going to be, typical cycles like this take 1 or 2 years before, they kind of really slow down the system.
Yeah, that's a great point. So what we're understanding fully is, at least a couple of years for this to translate in terms of slowing loan growth. But sir, let me talk about risk, because that is something that the RBI has over the last month really emphasized upon and acted upon, not just emphasized upon. Are you seeing a real risk, especially in the unsecured segment? Are you seeing a real risk there?
So you see, risk in the system has 2 layers, right? One is individual bank or NBFC risk, and one is systemic risk. The problem that RBI has been talking about recently is more around systemic risk, because they believe that a lot of these loans are given at usurious rates, very high rates, because it's not visible to the customer. 25, 26, 28% is very high. These means are not normal, and they are therefore asking whether are you earning abnormal rates, and are people just so desperate they're borrowing at these rates, and yet they might come to a situation where they're unable to repay it simply because sources of credit are gone. So once you lose all sources of credit, you can't repay because the loan has ballooned to a size where you can't possibly repay in your, or in the overall sequence of things. That portion, because it may come in the future, is why they're warning people right now. And why is that systemic risk? Once the individual risk is gone through at a number of such institutions, that means it's not just one NBFC, it's multiple NBFCs that get hit. It is then that the upstream companies like banks who lend to these NBFCs, they also get hit. And remember, they have a much lower risk weight on the loans to NBFCs. They had only 20% for AAA NBFCs and 50% for A-rated NBFCs. NBFCs themselves don't have other sources right now to borrow. They are borrowing largely from banks because the other source to borrow is the bond market. RBI does not give deposit licenses for NBFCs anymore. So effectively, your only other source is the bond market. What they do is they go to the bond market, issue bonds. Guess who buys their bonds? Banks. Banks buy. So that's what RBI said. RBI, you not only give loans to banks, go and buy their debentures when they issue it in the bond market. So effectively, you're the guys who have the largest exposure to that NBFC system. And the other source, which used to be mutual funds and insurance companies and so on, they have become unattractive. Mutual funds, at least, because debt mutual funds have been taxed at a very high rate. You don't get long-term capital gains taxation in debt mutual funds at all now. So the inflow into debt mutual funds has slowed or not gone up that much. So debt mutual funds themselves are not buying or are not big sources of capital for NBFCs. So they have to go back to the banks. And, at this point, for them to diversify their sources of funding is extremely difficult because this tax loophole is not under their control at all. And they don't want to issue bonds at a very high rate for borrowing. So they'd rather go to a bank and kind of make a deal over there. So at some level, you have systemic risk because the banking system is exposed to the NBFC system in a very large way. It is largest or second largest single, outside of large corporates. I think it's a fairly large destination for bank lending, NBFC itself, and that has been growing at 22 to 23% a year. So this aspect, this area itself is where there's a big concern on risk because your banks are lending directly to consumers. That has some risk. Banks are lending through NBFCs to consumers. So the NBFCs have trouble with this. So I think what RBI is trying to do right now is they address it, saying that this is going to happen at some level. So please beware. But they are only providing those early warning indicators. They're not going in harshly and saying you need to stop.
Sure. Understood. But will this therefore lead to a compression in ROA's profitability for NBFCs? Because there has been quite a few developments on the NBFC space, as you correctly pointed out. Mutual fund changes with regard to debt mutual fund. Now you have this change in risk weightage with regard to lending to NBFCs, and now you have the RBI commentary coming through as well.
Yes, so I think you're right in that this will crimp ROAs, this will crimp profitability at some level, but it may not be very much. So, give you an example. An NBFC that is lending to vehicles or lending against some array of things, so Bajaj Finance has maybe 61% of their lending book is secured. So that part of the book doesn't change very much. It's the growth that was coming in from the personal loans and all that stuff that is a little bit at risk. So you end up with that being a situation in terms of growth. And growth largely is where the profitability arises, right? So you get fees, you get higher loan rates from the relatively new from growing your current book, and also renewals from existing customers who will be rolling over their loans or taking fresh loans and so on. So some part of this will slow down growth. And remember, the RBI's idea is to slow down growth.
Sure.
So at some point they will slow it down, whether they do it purposely or not. So if they slow down growth and they increase the cost of funds and increase the risk weightage, both cases you will end up with lower, at some level lower, either lower ROAs or lower CARs, and there'll be dilution because of that.
Right.
There is a dilution that just dilutes the shareholder capital. It may not affect ROAs per se, but then, ROAs itself are determined largely by from it comes down from the means itself.
Sure.
So you'll have that as an issue. So I think, there will be some compression. There will be some. The fear is actually not so much of a profit compression, but of higher regulation that comes in the future that actually stops them, even the good guys, from borrowing from the banks easily.
Understood. Got it. Very interesting perspective. Very quickly, sir, if your quick two thoughts on risks with regard to the fintech, the models which fintechs are adopting, underwriting models. Is there a risk on that count? Because that was clearly flagged off by the RBI governor. He mentioned that please don't lend on the basis only on the basis of how algos are tracking lending patterns.
So I think that is not exactly what they said. What he said was, you need to retest the models. The models may be obsolete, may not have taken into aspect changing liquidity conditions in the market and all that stuff. Therefore, your lending practices, if they're based on that model may need either more inputs or a more a different thought process as well. Now, the problem with this is that lending models, let's say they're based on a credit score. They're based on reports by other institutions to CIBIL. So you kind of make a model around that. So what RBI is saying, listen, it's more than that. So you might have to take into account other factors like employment history and things like that, which are usually not submitted in an algorithmic way, right? So
Sure.
You'll have to do some background work to ensure that you are lending to people who actually have the capacity to repay, which currently, because the space has been so hot, people haven't really taken into consideration. I mean, for instance, you go to buy a loan, get a 0% EMI loan. Do they consider that? Do they ask you to upload your employment details? Do they know where you're employed at any point in time? Do they ask you for your current pay slip? Answer is most likely no.
Sure.
So that might be one of the inputs in a model that was there offline before this, that they would ask you for your current employment records, right? So you might be that RBI is just looking and saying, listen, you've got to tighten up your models to ensure that you're actually calculating capacity to repay because you don't have any collateral. So there are three things in lending. There is a capacity to repay, there is a creditworthiness, and there is a collateral. If you don't have collateral and you are unable to actually figure out capacity to repay because you're not taking any of those inputs into your model, all you're basing your credit decisions on is one of the three C's, which is creditworthiness. And that is a problem, right? So you could end up with a situation where your assessment of creditworthiness has gone to has not worked at all. Right. And if this becomes systemic, this is a risk. So I think yes, fintech lending is not. They're not saying don't lend on the basis of models. Sure. They're just saying expand the horizon of the models that you have. And honestly, today you can. For instance, if you know a person's email address and phone number, most likely you can figure out their employment details by looking at, say, LinkedIn or something like that. Correct. And you can easily figure out that this person is a creditor using models itself, completely algorithmic models. So right. If you're lending to people that you expect to be salaried, and you find out that this person is out of a job or recently or something like that, you might end up with situations where you don't want to lend based on one other parameter that you weren't considering in the past. That is what RBI is asking. Tone your models up. This will increase costs for fintech providers. It will decrease the amount of loans that they will eventually be giving, because of this. So, and also increase the time they will take. These instant loans may not be instant anymore. Sure. So that change might actually come into the ecosystem and hurt fintechs. But in general, fintechs as NBFCs also will hurt because they have relatively lower CARs compared to I think some of them have lower CRs compared to the listed ecosystem, and they're unable to raise capital as easily.
Right. Thank you so much. It's been a great deep dive. It's been great having your insights, reading between the lines. Growth to remain as is, as per Deepak Shenoy's view. He believes that rates will still take some time to bake in whatever the RBI has done in terms of policy action as well as policy commentary. And he believes that NBFCs, there could be some compression in ROAs. Fintechs need to, of course, be wary and take care of processes. Thank you so much. It's been a pleasure speaking with you, sir.
Thank you so much, Harsh. All the best.